Friends, in the previous session we have understood that there are four ratios in liquidity ratio, basically current quick cash ratio and basic defense interval ratio. Now we'll get started with current ratio. So what is current ratio, or what does the current ratio tries to convey? See, the current ratio will try to tell you what is the current liability and whether there are sufficient current assets to cover the current liability. Because current liability have to be paid, and it can be paid only out of current assets, and current assets should be greater than current liability. That's why this gap. Current liability should be, current assets should be greater than current liabilities. Now we'll understand this with some numbers. So we'll have liabilities and assets. Now we'll just have liabilities, current liabilities here. So the first current liability is bank CC. It can be called as cash credit or overdraft, and it is say 100. And the second one is sundry creditors, and it is 200. So there are only two current liabilities in our case. It is bank CC 100 and sundry creditors 200. And for paying these current liabilities, what are the resources we have? The first resource is cash and bank, which is 200. The second resource is stock, it is also 200, and third resource is receivables, it is also 200. So for paying 300, right, what is the resource available with the company? It's 600. So we have a lot, we have more. So we'll plot this in a chart, we'll see how it looks. The company has to pay current liability of 300, and for paying this 300 it has current asset worth 600. So here comes the comfort zone. This excess asset which the company has gives the liquidity comfort, because it need not be stressed or it need not be worried about the short-term lenders, because short-term lenders are only 300, it has assets worth 600, of which the remaining 300 is a buffer. So current liability is 300 and current asset is 600, so we can calculate current ratio also. What is the current asset here? It is 600. And what is the current liability? It is 300. So current ratio is current asset divided by current liability, which is going to be 600 by 300, which is 2:1. It means for every 1 rupee of current liability, this company has 2 rupees of current asset. Fine. We'll take another case to understand the current ratio implications. We'll have liabilities and assets, and on current liabilities we'll have same bank CC of 100 and sundry creditors, that is supplies of 200. On asset side there is going to be slight changes. So what are the resources which this company is going to have to pay this 300? One is cash and bank balance, which is 100. Two is stock, which is also 100. And three is receivables, it is also 100. So what is the liability? Liability is 300. They have to pay 300, and for paying 300, what is the resource they have? They have 300. So it is matching. Now we'll see how it will look like in chart. They have to pay 300, that is current liability, and for paying that they have equal asset of 300. Fine. So how the current ratio is going to be here? When the current asset and current liability are matching, current ratio should also be equal. So the current asset here is 300, current liability is also 300. So current ratio is current asset divided by current liability, which is 300 by 300, and the ratio is 1:1. That is, for every 1 rupee of liability, there is 1 rupee of resource or asset is available. So now we'll have case 3 to understand the current ratio. In case 1 we have seen current asset is higher than current liability. In case 2 it was matching. We'll have case 3. So we'll have liabilities and assets, and current liabilities are same. It is bank CC of 100 and sundry creditors of 200. And on the asset side, you're going to have cash and bank balance of 50, stock of 75, and receivables of another 75. So here comes the tragedy. The total liabilities are 300, whereas the total resources available to pay the liability is only 200. If you plot this in a graph, you could note that liability is 300 but the resources available is only 200. The current asset available is only 200. So this region which shows the gap is the danger zone, which no company should get into, because if you are not able to pay your current liabilities out of your current asset, do you think your fixed assets will fund the current liability? Answer is no. Current asset is something which will get converted into cash in short period, and if you don't have current asset, you cannot expect your fixed asset to convert to cash. If fixed assets have to be converted into cash, it would take more than 1 year, and by the time the current liability would have taken you for a ride. So this is the danger zone which every company should watch for in its financial, and they should never get into this trap. So we'll analyze all the three scenarios now. I'm sorry, we have not worked out the current ratio for scenario 3. What was the current asset? The current asset available was only 200, whereas the current liability was 300. So the current ratio is basically current asset by current liability. So it is 200 by 300, which is 0.67:1. For every 1 rupee of current liability, the company has only 67 paise of current asset. So this is a clear warning sign. So current ratio less than 1 itself is a clear warning sign that the company is not performing well, or it is not managing its cash efficiently. So now we'll do the analysis of all the three scenarios. We'll have scenario 1, 2 and 3. In scenario 1, our current asset was how much? 600. The current liability was 300, and there was something called net working capital of 300. What is that net working capital of 300? See, please note, the company had current asset of 600, of which 300 was funded by current liabilities. I repeat, the company had current asset of 600, of which 300 was funded by current liabilities. Then who funded the balance 300? That balance 300 was funded by the group called net working capital. Net working capital is nothing but basically it is the long-term funds available in the system, which is made use for funding portion of current asset. So here, out of 600, 300 was funded by current liability and 300 was funded by net working capital, and it is only because of this reason the current ratio of this company was at comfortable level, because 50% of current assets were funded by net working capital, and that should be the ideal scenario. So that's why here the current ratio is 2:1. And what happened in scenario 2? The current asset was 300 and current liability was also 300. So there was no net working capital. It means all the current assets were funded only by current liabilities. Nothing had come from long-term funds. And here what was the current ratio? It is 1:1. In scenario 3, what happened? Current asset was 200 and current liability was 300. Is there any contribution from net working capital? Whether net working capital was used for funding current asset? No, it is rather negative net working capital. That is, portion of current liability which was in excess of requirement of current assets is used in negative way. So it is called as negative net working capital. It means this 100 out of this 300 has not gone for current asset, it has rather gone for non-current asset. So what will be the implication? Once the short-term funds goes for long-term purposes, it will invite unwanted troubles. And here what is the current ratio? It is 0.67:1. For every 1 rupee of liability, the current asset available is only 67 paise. So in this session we have understood a little bit about current ratio. In next session we'll understand what is quick ratio.